Good afternoon, everyone, and welcome to today's Learn at Lunch webinar. We will hear from Dr. Courtney Burr as she explains tools that producers may use to conduct a financial health review of their operation. Please ask any questions through the chat box by clicking the chat button at the bottom of the screen, and Dr. Burr will answer your questions at the end of the presentation. Additional information on this and other farm management topics may be found on the e-farm management page, and I will share this link in the chat window. Dr. Burr, I will turn it over to you now.
Great. Brent, just to double check, am I in full screen for the PowerPoint slides?
That is correct. The PowerPoint slides are full screen.
Great, thank you. All right, so this topic today is not everyone's favorite topic. I will be upfront in saying that it is a little bit boring, but it is really, really important to kind of understand what a beginning and ending balance sheet is, to understand how you can leverage the knowledge of your own farm finances to make great decisions. So we're going to go through everything. I kind of sold this to Brent as a like farm management class style. So bear with me, it's good information. Okay, so there are several different pieces of the farm business financial statement. The first one is the balance sheet. It's also called the net worth statement or statement of owner's equity. You also have the income statement, and you have the cash flow statement. Both the income statement and the cash flow statement are based on information from the balance sheet. And so like what I'm showing here with this income statement is that BS5C actually stands for balance sheet. So if you have your balance sheet done first, it can help you complete these other financial statements that make up the core of financial decision-making information. So what do you do with the non-farm income and expenses? I'm putting this slide up front because it is something that comes up a lot. So when we are thinking about the farm finances, we are thinking about the farm, right? So we need to make sure that we're analyzing the farm business itself, farm income and expenses only. However, depending on certain circumstances, you may want to include non-farm income as cash available to the farm. So you may want to assess your family living withdrawals and other things like that. It is important when you're including off-farm income and family withdrawals and things like that, that it may not provide an accurate picture of the farm's performance. So my recommendation for people, if you want to include some of those off-farm influxes of cash and things like that, make two balance sheets. Make one that shows just the farm income and the farm sales and things like that, and one that also includes the off-farm income that you're maybe using to infuse cash into your farm enterprise. So the stock concept for the balance sheet is that it is a snapshot of business financial situations at a given point in time. This means that we're going to have to redo balance sheets. It's not something that you do once and then you never do again. It is a snapshot. It can be completed at any point during the accounting period. However, traditionally, it is done at year's end. So it'll be December 31st. You may want to do interim balance sheets if you're applying for a loan. During the peak of COVID, there were programs that people were applying for that required beginning and ending balance sheets. So you may want to update that balance sheet and kind of refresh it. Using December 31st allows the document to be the end of year for 1 year and the beginning of the year for the next year at the same time. So when you're completing beginning and ending balance sheets, if you're on top of it, you're really only doing that once, so that it's beginning for the next year is the ending for the previous year. So this is kind of the balance sheet structure, and I will go into detail about all of these different pieces of the balance sheet. But in general, what you have on your left-hand side is you have your assets. So those are your current assets, your intermediate assets, and your fixed or long-term assets. And that ends up being your total assets. For your liabilities, you have your current liabilities, your intermediate liabilities, and your long-term liabilities. That will add up to be your total liabilities, and then you use that to calculate your net worth, and then you end up with your total liabilities and your net worth. Just so that you know, a current asset is less than 1 year, an intermediate asset is greater than 1 year but less than 10, and a fixed asset is greater than 10 years. And we'll go into a little bit more detail about that. So assets are what you own. So current assets are cash or assets that can be converted to cash through normal operation of the business expense during the year. So that is your cash, your checking, your savings, that's your accounts receivable, your feed, supplies, and products for resale, livestock raised for sale. So these are just normal things that you would be selling during the year. So intermediate assets, like I mentioned, those are things that can be liquidated quickly. So think short term. They generally would require more time to attain a fair price and would drastically alter the business's ability to operate. So that's your breeding livestock, your machinery equipment, movable buildings, coop stock, leases on any of those above items. So these are things that you can sell. You will still be a business if you sell these things, but you can't just offload them quickly. They might take a little bit more time to be able to sell them and get a fair price. So long-term assets could not be liquidated without the business being terminated. I say in most cases, there's always caveats to these things. So that's the land and buildings, leases on real estate. So if you sell all of your land, you are no longer a farm, right? So that makes that a long-term asset. I put a skull and crossbones here to remind people, like, you're done. If you sell all of your long-term assets, you're just done. In case you ever read fact sheets from other universities or other books and things, alternative structure for assets are current and non-current assets. So liability is what you owe. It's your debt or obligation to someone else, represents an outsider's claim against one or more of the business assets. So liabilities are categorized by the term of the loan, not the life of the asset. So hopefully the loan is shorter than the life of the asset, right? But sometimes you hear of people who are getting upside down on things, right? So that means that they're going to have to keep paying on this item beyond the life of the item. And so that's why when we're doing these balance sheets, it's by the term of the loan, not the life of the asset. The original term of the loan determines its placement, not the years remaining. So current liability, these are obligations that you're likely to repay within a year. So this is your accounts payable, this is your feed, your bills, those sorts of things. It's your operating loans, your short-term debt for capital purchases. It could include your principal payments on intermediate and long-term debt, but it has to be due in the next year. So intermediate liabilities are obligations where the repayment schedule is within 1 to 10 years. So that's your machinery loans, your breeding stock loans, some real estate improvement loans if they're short enough. And then your long-term liabilities are obligations which have repayment schedules in excess of 10 years. So this is most commonly real estate. So your land and things like that. So a note on financial leases. Financial leases are both an asset and a liability. So you have to just be very careful that you have that in both places. So owner equity is the amount of money left over for the owner if the business assets should be sold and all liabilities paid as of the date of the balance sheet. So if you sold absolutely everything, whatever that number is, positive or negative, it's going to be your owner's equity. So we kind of went over everything that's in the balance sheet. And this is kind of where the more exciting piece starts happening. So you can take that balance sheet that you filled out, you followed all those rules that I just talked about, and you can do some analysis. And that's actually what helps you in your decision making and helps you understand the financial health of your farm. So when you talk about solvency, solvency answers the question, would your assets cover your liabilities if you sold? So there are three different numbers that we look to answer kind of the solvency question. It's your debt to asset ratio, your equity to asset ratio, and your debt to equity ratio. I'll go through those. So we have this fact sheet. It's called the Farm and Ranch Stress Test. It's been around for a long time. It's a really great fact sheet. And so all of these sort of slides that tell you, green, yellow, red, all of that's in the fact sheet along with these actual equations. So if you get a little lost during this or you want to make sure that you have this, I actually have this fact sheet taped to my wall because I look at these all the time. So your debt to asset ratio is your total farm liability divided by your total farm assets. A higher value is considered an indicator of greater financial risk. So less than 0.3, you're in the green, you're doing okay. 0.3 to 0.6, yellow, you might want to start watching out. And then greater than 0.6, you're in the red. And this measures the share of business assets owed to creditors. Your equity to asset ratio is your equity divided by your total assets. And higher values are considered a better financial situation, and it measures the amount of farm business assets owned free and clear. So these are things that you don't own money on. This is what you actually own, and that kind of goes into how solvent you are if you were to get rid of those things that you actually own. That kind of lends itself to the solvency question. So your debt to equity ratio is the total liabilities divided by your equity. So a smaller value indicates a stronger financial position, and it measures the amount of farm debt relative to the farm equity or net worth. So the solvency take home. So solvency measures where the business is today and helps predict the likelihood for experiencing financial difficulties. So again, there's a lot of different situations where you may be in the yellow or maybe a little bit in the red, but everything else looks great. You may not have financial difficulties, but it's important to understand how these numbers are calculated, what that number actually means, and of course, compare that to all of these other measures that we're talking about before you make a final decision and say, oh no, we're in trouble, or okay, we're doing fine. Beware of individual circumstances. So a very profitable business paying a low interest rate, right now interest rates are quite low, may not be in financial difficulty with a debt to asset ratio greater than 40% or even 70% in some cases. So that's what I was saying, you have to kind of look at the big picture and not just individual things. You are truly in financial difficulty if the debt payments exceed the dollars available to do so. So if you look at how much money that you have, in reserves, how much money you're making from your farm, and if that debt payment is bigger, then you really do have a problem. So liquidity looks at whether the farm is able to deal with unexpected shocks in the short run, where the manager has little flexibility. So, we have kind of talked about assets having three categories. Well, you may be able to sell some things in the short run that you're not able to sell in the long run, like breeding livestock. Like, sure, you could probably sell that tomorrow, but you're not going to get the best price. So we're talking about the short run right now. You look at three different things: your current ratio, your working capital, and your working capital to gross revenue. So your current ratio is your current farm assets divided by your current farm liabilities. So if you're greater than 2, you're in the green. If you're between 1 and 2, you're in that yellow range. Kind of start looking at other ratios. If you're less than 1, you're in the trouble area. And the current ratio indicates the extent that current assets can be sold to cover your current liabilities. It's pretty static in nature. There's no timing of the cash flow in this ratio. So for your working capital, this is the total current farm assets minus the total current farm liabilities. So kind of as a guideline, if it's positive, larger is better. It's similar to the current ratio, but it's an actual dollar amount rather than a percentage. So all of those ratios, of course, are percentages. And so this is actually a dollar amount. It's a little bit difficult to compare working capital to other farms. It depends on the size of the business. It depends on, that particular farmer or rancher's risk preferences and things like that. So it's kind of a number that's best to compare across years within your own farm versus, comparing to other people, which is why there's not a red, yellow, green for this number. It really kind of depends on the individual operation. So working capital to gross revenue. Working capital divided by gross farm income. It measures the operating capital available against the size of the business. So a higher percentage means that you have more cash available to meet the short-term needs of the business or farm without use of additional financing. So this is what you can cover on your own without having to get, an additional loan or, sell, medium or long-term assets. So the liquidity take home. Measures of liquidity tell you how well the business can withstand shocks, which you would interpret in the production process. There is no right or wrong level of liquidity. It's all about your preferences in terms of your risk management, how comfortable you are, how stable and reliable your income is. Some creditors have standards, however, for current ratios, and it varies by region or farm type. So if you go get a loan and the bank happens to have some internal standard, you don't really have a ton of control over that. That's just something that they've set. There is a continuum of vulnerability though, and it depends on the age of the business and of course the risk preference of that manager. So some more debt analysis information, accounts payable as a percent of the total debt. So that's your accounts payable, so what you owe, divided by the total debt times 100. And it gives a feel for the level of accounts payable, and it's dependent on the total debt level for accuracy. So your debt structure is equal to your current liabilities divided by your total liabilities times 100. So again, we're getting that percentage in there. It's the portion of total liabilities that is due in the next year. So I know that was a lot. We try and keep these between 20 and 30 minutes. If you are interested in getting a balance sheet done and you're a little shaky on it, we have a great program for you. So the Farm Financial Planning Program for right now is actually free for all producers of all types. So we are currently accepting any kind of producer, any kind of size, all of those different things. And to join, you can either go to the website. This is a QR code. You can scan it with your phone and fill out the information form, or just send me an email. We prefer to have, of course, the name of the producer, phone number, and then the county or city that you live in. And the reason why I need the city is because we actually have a team of people who are trained and helping you complete these balance sheets and then other financial things as we kind of grow this program. And so they will work with you on that. And oh, thanks for putting that in the chat, Brent. So they will work with you, and we're trying to find the area or county educator that's trained that's closest to that producer. So that's why we need to know where you live. We're trying to kind of match people out and kind of spread it out. So if you are a little uncomfortable with figuring all of those numbers out yourself, we are here to help you with that. If you're interested in more information regarding farm financial planning or just other items, we have a lot of different speakers that will be at the Women in Ag Conference. So that is going to be August 5th and 6th of this year. I will be giving a presentation about farm finance. I'm not sure the exact topic yet. I'm working on that. And there'll be other people who are speaking as well. So that's another opportunity to get some more information if you're interested. And that is the end of today's session. There is a survey link here. If you have any questions, I know it was a lot of information. Add your questions to the chat, or feel free to contact me at a later time.
Thank you, Courtney. As you mentioned, I did share a link to the Farm Financial Planning page in the chat box. And if you're on this webinar with us today, you can now unmute yourself to ask questions or ask them through the chat. Either way, those are both options. And we have the survey there. So we appreciate your feedback. I also want to tell everyone that our next webinar is scheduled for August 17th, also at noon. And in that webinar, we will hear about current Oklahoma land values from one of our recent surveys. So that's the next coming webinar. And so, yeah, feel free to
Wow,
ask.
Brent, I did such a great job explaining all of those ratios in 20 minutes that no one has any questions.
Yeah,
Call it a success.
it was a success. It was a success.
Dr. Bird, what's the anticipated length that the help with the balance sheets is going to be? Is it just, throughout this year, 2021, or is it going to go on to other years?
For the farm finance program?
Yes.
So we received the grant last year. We have some money left in the grant because of COVID and no travel. And we actually received the grant again this year. So we're looking at, running this program for at least probably another 2 to 3 years. And so hopefully we'll get some folks that get into the program, and then we can start doing more complicated things. So once you've done a beginning and ending balance sheet, we'll be able to help you make decisions regarding, buying pieces of machinery or adding some land and things like that. So there's a lot that we can actually do with this program. It's just a matter of getting the word out and getting people involved in it. And it's something that we hope to help people with every year. So once we have your information, it's really easy for us to update those beginning and ending balance sheets year after year, and then go through these farm and ranch stress test pieces with you and just make sure that your farm finance health is still doing well. So I anticipate doing this program for at least the next couple of years, and kind of see how participation is after that.
Any other questions for Dr. Burr today while we're all here? And as she mentioned, she did include her contact information in the slides. So, and we recorded today's webinar, and we'll get it up on YouTube and share that link as well. So if there are no other questions, thank you everyone for joining us today, and hopefully we will see you on August 17th for the land values webinar.
Thanks, everyone.